In this episode, I'll break down the new week opening gap and how to use it in the market. Once you understand this concept, you'll be able to identify major moves, whether it's a reversal or a continuation. The market also often continues in its direction for days, regardless of the time frame you trade. Let's get straight into it. Just briefly as an introduction, this is the Sunday, February 5th, 2023 new week opening gap. And the first thing you need to understand is how to correctly locate it and why we are even using it in the first place. Now, the way you want to locate this is you want to go into a lower time frame chart. You do not want to use your daily chart. And the reason for that is because the daily chart is using a settlement price. And that settlement price may not be aligned with what we are trying to observe here. So to avoid any kind of misalignment, what you want to do is drop down to something like a 1-minute or a 5-minute chart. Now, once you are on that lower time frame, you are going to be using two specific price points. The first one is the Sunday opening price, which in this case is represented here on February 5th. And the second one is the closing price on the Friday prior. So now you have two different price points, and there is a difference between those two. That difference between the Friday close and the Sunday open is what we call the new week opening gap. And right in the middle of that gap, we have the midpoint, which is referred to as consequent encroachment. So now you have a complete structure. You have the Friday close, you have the Sunday open, and you have the midpoint between them, which is consequent encroachment. And that is exactly what it looks like on the chart. Now, if we move forward to the next week, which would be Sunday, February 12th, 2023, we do the exact same process again. We take the closing price on that Friday, we take the opening price on Sunday, and then we mark out the midpoint between those two levels. That gives us another new week opening gap. Now, the reason I use the ICT new week opening gap is because it gives me a sense of large fund fair value. What that means is the market will generally move around these levels, sometimes moving away from them, sometimes pulling back into them, but consistently referencing them as areas of value. Now, everyone already knows that gaps exist. I didn't invent the idea of a gap on Sunday. But what most traders don't understand is how the algorithm actually uses these gaps. Most traders are trained to think that once a gap is filled, it's over, and you move on to the next thing. That is not how the algorithm works. The algorithm refers back to old inefficiencies and old liquidity voids, and that is exactly what this gap represents. This gap between Friday's closing price and Sunday's opening price is a true liquidity void. There is no trading between those two price points, no buying, no selling, no data printed between them. So because of that, the market sees this as an inefficiency, and it can come back to it not just immediately, but even weeks later, a month later, or even further out. So when the market moves away from that gap after repricing into it, it can still refer back to it at any point in the future, and that is why I keep these levels on my chart. Now, what I've learned over time is that it's not enough to just have one of these on your chart. You want to have multiple. At a minimum, you want at least 4 weeks of new week opening gaps on your chart, but personally, I like to have 5. The reason for that is it gives you a rolling perspective of fair value, not just a static 4-week look back, but something that overlaps and gives you more context. Now, if we take a closer look at the chart here on a 1-minute time frame, you can clearly see the Friday closing price and the Sunday opening price. And yes, sometimes price will open and immediately trade back into that gap. That is completely normal. You would expect that behavior. But once that happens, I do not ignore the gap like most traders do. Most traders will say the gap is filled and move on. I don't do that because the algorithm will continue to reference that level. So what I do is I annotate those levels using a ray. A ray is simply a line that anchors to a price point and extends out to the right. So I anchor one ray to the Friday closing price, which is at 4:59 p.m. Eastern Time, and another ray to the Sunday opening price, which is at 6 p.m. Eastern Time. Now I have my two reference points clearly marked. Then I take it one step further by using the Fibonacci tool. I anchor it from the Friday close to the Sunday open, and then I mark out the 50% level. That 50% level is what we call consequent encroachment. because this is an inefficiency. That midpoint acts as the mean threshold of that gap. So now what I have is a fully structured new week opening gap. I have the high, the low, and the midpoint. Now, if you want to stay organized, you can label these gaps by the Sunday date so that you know exactly which week each gap belongs to. This becomes very useful when you have multiple weeks on your chart, because otherwise it can get confusing. You can also go a step further and divide the gap into quadrants. You already have the high and the midpoint, so you can find the midpoint between those to get the upper quadrant, and do the same between the midpoint and the low to get the lower quadrant. Personally, I don't always draw those lines, but I am aware of them. Now, as we move forward week by week, for example, February 19th, February 26th, and March 5th, we repeat the exact same process. Friday close, Sunday open, midpoint, and extend those levels across the chart. Now, once you have multiple weeks plotted, this is where everything starts to come together. You will begin to see how price refers back to these old new week opening gaps. They often act as support and resistance. Price will consolidate around them, reject from them, trade through them, and even use them as targets. Sometimes price will stay close to a new week opening gap and keep coming back to it. That tells you the market is in consolidation. It is range-bound. But when price moves away from a new week opening gap and does not return to it, that is when you are in expansion. That is when the market is trending. You can also see how price will move from one week's gap to another, almost like it is being pulled from one level of fair value to another. So this is not just about marking a gap and forgetting about it. This is about understanding how price references fair value over time. That is why I keep these on all my charts, whether it is NASDAQ, ES, Dow, the dollar index, or Forex pairs like EURUSD and GBPUSD. And the best part is, this is very easy to maintain. Every Friday when the market closes, you mark the closing price. Then when the market opens on Sunday, you mark the opening price, measure the gap, mark the midpoint, and you're done. You save that as a template, and now every time you load your chart, you already have a structured view of how price is interacting with fair value across multiple weeks. And once you start paying attention to how price reacts around these levels, the market will start to look a lot less random and a lot more structured. So that is the complete understanding of the new week opening gap and how I personally use it in my trading. At first, it might just look like a simple gap on the chart, but once you start tracking it over multiple weeks and actually paying attention to how price reacts around these levels, you'll begin to see that the market is not moving randomly. It's constantly referencing these areas as fair value. The key here is consistency. Mark your Friday close, mark your Sunday open, track your consequent encroachment, and keep multiple weeks on your chart. Over time, this will start to build a clear narrative for you. And just like everything else in trading, this isn't about using one concept in isolation. You want to combine this with your bias, your liquidity, your PD arrays, and your entry models to build a complete framework. If you stay consistent with this, you'll start to notice how price moves from one level to another with purpose, and that's when things really start to click. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.